Hello, everyone. Welcome to this Wharton Club of Delhi webinar, Investing in Turbulent Times. I'd like to welcome you all. Thanks much for taking out the time to be with us. We have folks joining in from all over India and the world. And of course, we've got our speakers who are joining in from Boston, Mrs. Sinha, and Ms. Radhika Gupta from Mumbai. And I'll be shifting soon to Rohit to introduce them. But before that, just wanted to kind of talk about investing in turbulent times. And of course, you're all seeing these crazy dips and peaks. This, of course, is the US S&P 500 index. Just wanted to kind of start with this and set the context and the reason why we are here, because just over the past month and a half, we've seen the US markets dip almost 34% within a month and then go back up. Last week was one of the best weeks in terms of a bull rally since 1938 in the US. And of course, Indian stock markets are reflecting that as well. They're all correlated. And we are seeing this across the globe. So today with Ms. Sinha and Mrs. Gupta, we'll try and figure out what's going on and what lies ahead of us. So I'd like to move to Rohit Kumar, who's the president of the Wharton Club of Delhi, and he can take it from here. Rohit.
Okay. Thanks, Abhay. And thank you, Punita and Radhika, for being willing to do this webinar at this time. I think, as Abhay said, it's a unique time for most of us who are seeing different things happen around the world and in India. And you probably have more experience of looking at markets in various phases. So we'd love to hear your perspectives. For those of you, Punita is Wharton PhD and a master's in finance from the Wharton School prior to the PhD, and is on several boards and has run probably for the longest time the first India-focused fund that became a big fund for over 20 years. And Radhika is running the asset management business of Edelweiss in India. And again, is somebody who has run India's first hedge fund, among other things. And obviously their profiles are very illustrious. So anything I say will be taking away from what they will talk about. So anyway, let me introduce, I hand it over to Punita to talk. And we are at 97 participants right now, so really happy. And I'm seeing a lot of messages on chat that I'll just come and go through if there's anything that comes up. But let's go ahead. And Punita, over to you.
Hi, thank you, Rohit. Thank you, Abhay. I guess I'm not able to get the video working, something on your end. But let's do it without the video, just the audio. So thank you all for listening in on a Sunday evening. And it is an Easter Sunday and the markets were closed on Friday. So it was kind of a long weekend for at least the equity markets. We'll see what happens tomorrow. Let me just give a quick overview, which all of you probably aware already, but just to set the tone, the corona pandemic is now infected most countries. And this chart that we've put up, which I presume you can see, is showing you where the epicenters are. And North America, where I am right now, is a big epicenter. We've got the largest number of cases. You know, the mortality rate is about 3.5%. India, compared to its population, has got one of the fewest cases. These numbers are dated because every day they increase. And the mortality rate in India is at about the same rate, I would say, as the US. In some of the European countries, the mortality rate is far higher. We'll go to the next page. So in this kind of an environment where this is now a global crisis, what started off as a localized health crisis has now become a global health crisis, and soon a global economic crisis if things are not contained soon. So in response to that, what did we see? We saw all asset classes across the world decline. and there was really no place to hide. Indian markets fell about 30-some%. The US markets also fell sharply. The only place where you could actually make positive returns was US Treasuries and German bonds, and to some extent JCBs. But everywhere that you look, it was a bloodbath. We'll go to the next page. So what we've also seen during this time, as always happens, that risk aversion does drive fund flows, and this time around was no different. Of course, the fund flows moved rapidly away from the high risk markets in terms of where they saw the pandemic spreading. And in fact, as you can see, the dash to cash, the US money market assets have approached crisis era highs. So people have moved out of equities into money markets, and money market funds have really, people have really fled to money market funds, where you can see the assets are at kind of the last 10-year, almost right pre-2000, around the 2008 crisis, we're almost getting there. And in terms of the equity markets, US has had significant outflows, as have most of the other markets, but the only places where there have been some inflows, and this data again is a little dated and it keeps changing week by week, is that the Hong Kong, China markets is where actually there have been inflows. And the main reason, of course, for that is that what a crisis that started in China was contained relatively quickly and was localized. And therefore, people feel that as of now, the only place where there is still some economic activity happening is in Hong Kong, China, and businesses are kind of back to normal levels. In fact, Apple stores are, had announced about 2 weeks ago that they're shutting down everywhere in the world, and except, I think the only country they have their stores open are in China. So ironic as it is, a crisis that started in China is now affecting the rest of the world, but China is kind of back to some bit of normalcy. So we'll move to the next chart. And what I wanted to show here was that give some context of what happens in crises. And we've gone back. I started investing in India in 1991, 92, when the markets opened up for foreign investment. And so I've gone back to the crises that I've seen in my lifetime in the equity markets. And what we've seen is that in previous crises, markets have fallen a lot more than what we've seen today. So markets have fallen on average 50%. In 2008, they fell 58%. 2020, they're so far down about 30-some%. There has been a bit of a recovery. So the markets haven't quite fallen to the levels that we've seen in previous crises. And in terms of the peak to trough months that the decline from start to finish, it's generally about a year. So, and the recovery time is about 1.5 to 2 years in equity markets. So I'll show you in another chart how the correction looks pictorially, graphically. In the US markets, it's been roughly about the same. The markets do fall about, on average, of course, much less than India, about 25 to 30%. Of course, India being a more volatile market, it falls sharper, except in 2008, where the US markets also fell about 50-55%. And the months, again, to recover, in 2008, India recovered much faster than in the US. The US markets took a little bit longer to recover, and on average in the US markets, there is quite a bit of disparity on how many months it takes for the equity markets to recover. But what is also interesting is that the months of GDP recovery is also somewhere between half a year to about roughly 2 years. And corporate profits also take about a year to recover. This is just going back to 1969-70, but I've gone back as far as 1929, which was the Great Depression. And we really hope we don't end up in a Great Depression kind of scenario. There is some risk that there is obviously some risk that exists. I wouldn't say it's zero, but in 1929, it took like many, many years, over almost a decade, for the economy to recover. So we hope that this is going to be short-lived, like we've seen in the previous crisis going back to 1990s. Let's go to the next chart, and I just wanted to show how sharp this fall has been and how rapidly it's happened. It's happened. The red line is the fall, which has really been about just 30 days. We've seen a 30% plus fall in about 30 days, whereas in the previous crises, the fall has been more of a slow, there have been some sharp falls, but it's been more of a slow grind, going, all over about 3 to 4 years. We've seen particularly in 2000, that was kind of the longest period for markets to fall from their peak to trough levels. But in 2008, we had a sharp fall, but again, markets did have volatility. There were periods where they, retested kind of their previous lows and then continued to either recover or fall back down. So we've not seen a sharp recovery, a one-way sort of movement, which is down and up in any of the previous crises. And I suspect it'll be somewhat like similar, given if history is any guide, that this virus is probably going to take some time to settle down, and unless there's a cure that comes out really quickly, or a vaccine that comes out really quickly, this thing could take some time, and so we might see the markets jittery for a while. It's a little unclear how quickly things will settle in, but this is just to give you some context as to what has happened in previous bear markets. So let's move on to the next chart, and I wanted to also tell you a little bit about what valuations do in previous crises. In previous crises, as you see here, on a price to book, we are pretty much close to the 98, 99 crises, which kind of makes the financial sector, which is the one that we look more on a price to book, look relatively more attractive in terms of their valuations. On a price earnings, we are not again at the bottoms. India has hit valuation lows at about 10 times multiples in the previous crises, and today we are at about 12 times or 13 times, depending on what date you look at these numbers for. On a yield gap too, in previous crises, we've seen the yield gap turn negative. Right now we are at close to zero, but we haven't really turned negative. So if you look at all valuation parameters, India's valuation still above historical lows. I'll move on to the, and the same kind of, I had the US chart here too, but I removed it just given the time constraints. But in the US markets, we've seen similar pattern, that the US markets also haven't hit their previous valuation lows. Markets have had, traded as low as 8 or 9 times, and today the US markets are trading at about 14 or 15 times multiples. So, so still, I think from a valuation perspective, we haven't really hit the negative sentiment lows. Now, turning over a little bit onto the economic data, I had GDP growth charts, but the numbers were so dated, I kind of removed them. So I'll just talk to it. The GDP growth forecasts have been coming down, and the IMF had revised down India's GDP forecast anyway to about from 7 to 5.5%. But I think those numbers are also being further revised down. We've seen Morgan Stanley and a lot of the sell-side firms bring down the forecasts further, and they, in fact, for the next quarter or two, they are forecasting negative GDP growth. So -2%, -1%, and that's kind of a consensus building up around those numbers, that in India, the GDP growth could easily turn negative for the next 2 quarters, and then depends on how the economy is handled. There is a chance that the numbers go back up in a year or so. And for the US markets too, the US economy too, there is concerns on what the GDP numbers will look like. Unemployment is at all, is really picking up. And from what was a fully employed economy, which was growing at about 2.5% to 3% real GDP, now the unemployment as of today is almost a couple of weeks ago, 6 million Americans filed for unemployment, and the unemployment and the economic numbers are again concerning. Now, of course, this is a presidential year in the US, unlike in India. So the US is going all out in terms of providing fiscal stimulus so that the economy doesn't dip as rapidly as it can. And President Trump is doing, although a lot of people criticize him for the late response, in terms of the fiscal stimulus, US has actually laid out the red carpet for a lot of different segments of the population. So on the right table, you can see that the US's fiscal package is about 10.7% of GDP. And in absolute terms, obviously that's a very high number given US's GDP is much higher than India to begin with. And the only countries that have given a much higher fiscal stimulus is the European countries, UK, Germany, France, and Spain have given about 15 to 16% of their GDP in fiscal stimulus. And India has given, unfortunately, only about 0.8% of GDP as fiscal stimulus. Of course, India doesn't, the economy wasn't doing as well as the US economy to begin with, but the fiscal stimulus has been quite low. Of course, there is a lot of discussion, as you probably have read in the papers, that the government will come out with more rounds of fiscal stimulus. And therefore, I wouldn't just say that India is only going to stay at 0.8, but I'm just saying that the response from India compared to other countries, just wanted to show you that. Now, in previous crises, India also, if you can see in 1996, India gave about 350 basis points of fiscal stimulus and then in 2008 also there was about 500 basis points of fiscal expansion. So I think given India's own history, we can expect a larger fiscal response coming. In other countries as well, the fiscal response was maybe 2 to 3% in previous crises. In the US, as you can see from the chart below, and now US is at 10.7. So the scale of fiscal stimulus is significantly higher than in previous crises, which maybe means two things. One, either this crisis is worse and therefore the governments are going all out, or second, that we will arrest this crisis sooner because the extent of fiscal stimulus is so high that the GDP growth declines that we've seen in the previous crises won't happen. And that, I think, is a little hard to predict as to which one of these two is going to be the outcomes, because the data on the coronavirus is still coming out, and it's not conclusive as to if we are out of the woods yet or not. So we'll move to the next page. Now, in terms of the positives for India, of course, has been the sharp decline in oil prices. And therefore, that gives India a little bit more room to provide more fiscal stimulus, because the correction in oil prices has given India a bit of a fiscal boost. So I would say the amount of fiscal boost India has got from the correction in oil prices is pretty much passed on right now through the fiscal stimulus. And so really, India hasn't really done any fiscal expansion. And the monetary responses have been aggressive as well, but again, less than what we've seen in previous crises. In previous crises, we saw India had 500 basis points of easing, 600 basis points of easing in 2008, and today it's 150, and this was as of March 20th, after which the RBI announced more cuts. And so, well, we are in the 200 to 300 basis points range right now. We are still below the past crises. So I think there is more room for India to act on, and hopefully the economic impact won't be as negative if they do. And in the US, of course, the interest rates have also come down now to 0%, 0 to 0.25% is the Fed funds rate. So obviously the monetary easing, the fiscal easing, everything has been a lot higher in the US. And some of it is going back to the fact that we are the whole world is watching the US, and we are in a presidential election year. So the next chart is showing you some good news, not good news, some actually, sorry, that's the last chart. So this chart is actually, interestingly, you know, we've never had a crisis, a health crisis that has turned into an economic crisis of the magnitude, even if you go back to history, even further than 1970. And so what have we plotted here is, you know, all the previous health crises, which were more localized. So the SARS, the swine flu, were more localized to Asia. Some of the other crises were more localized to Africa. And so none of them became a global pandemic of the magnitude we've seen now. And therefore, the economic impact of those health crises were not as significant as they are now. And even the impact on the equity markets wasn't as significant as it is now. So in the previous crisis, as you can see, markets didn't really react very much on a 1, 3 month or a 6 month basis. They took it in their stride. So this is the first, I wouldn't say first of a kind, but this is one of a kind health crisis that is actually leading to an economic crisis, and not just a localized one, a global one. And this where the medical science and the economists, so it's the medical practitioners and the economists are really intersecting. And so if the medical science can come up with a cure or a vaccine, then the impact on the economy will not be as sharp. And at that point, the economists have to really withdraw the kind of stimulus that they've given, particularly in the US. Otherwise, we would have inflation and higher interest rates, and that could lead to another kind of economic crisis. So I think we really have to see very strongly coordinated efforts from the health side as well as from the economists, and both have to work very closely together. And yesterday I did a webinar with a group of medical professionals in Boston, and it was interesting because the conversation was very different. They talked a lot about their perspectives on how much the lockdown should be, and where we are in the stage of trials and vaccines, and therefore you can extrapolate from that as to what that might do to the economy to some extent. So it's a real interesting intersection between two sciences, the medicine and economy. The last chart is basically what I was talking about. There's always light at the end of the tunnel, and at least for equity markets and even the economy, even though we may have contraction in the GDP output, we have in the previous crises always seen markets recover. Now, the time of recovery varies depending on the country, on the equity market that you are invested in, and the extent of the crisis. If you go back to 1929, it took a lot longer, but still, if you live long enough, you make money in the equity markets. So while no one can really time the bottom, and as I said, while we haven't hit valuation lows, we're getting close to it. But if history is any guide, markets will, remain jittery until everything is out of, clear, and we could see markets rallying, and then markets maybe perhaps correcting again if the data doesn't come out to everybody's satisfaction. So as you can see, the markets recover between 70 to 100% after these crises. So I leave you on that positive note that there is light at the end of the tunnel, whenever that is. Thank you.
Right. So I think we'll hand it over to Radhika. A couple of people are sending in some questions. So my only request is keep the questions till Radhika finishes, and then we'll go with them in the one by one as soon as we're able to move to that part of the webinar. So Radhika, over to you.
Terrific. Thank you so much. Thank you everyone who is listening into this from Delhi, Mumbai, and around the world. And it's always a delight to do stuff for our Penn and Wharton clubs. The good thing about being the second speaker in these things is that the first speaker has so wonderfully done all the work that you have very little to do. And as a result of that, I'm going to skip nearly all the slides I had. I think Punita gave you a very good economic picture of where things were in the US and India. And I think the summary of that is a couple of things. One, that we live in extremely uncertain times, and you can't, even those of them. So I graduated in 2005 and my first crisis was 2008. But can I take the lessons of 2008 and apply them to 2020? Hard to say. I think they're very different. I think the world has become better at understanding crises that are financial, because it's about rescuing a couple of financial institutions. We are more equipped to handle bank failures. Then we are equipped to understand crises in health. So I think one, things are very uncertain. The second is there are obvious dislocations in financial markets. And I think Punita talked a lot about equity, but in the context of India, in fixed income also, there are tremendous dislocations. These dislocations mean two things. One is that there is tremendous pain in your portfolio as equity and fixed income investors in India, but also that there is tremendous opportunity because, as she said, valuations have come down. They may not be at their bottom. Credit spreads are high, etc., etc. Ironically, there is, and since this whole thing started in China, one of my favorite words in the Chinese language is the word called Weiji, and it's the Chinese word for crisis. And it is a blend of two words. Wei means danger and Ji means opportunity. And I think investing today is a little bit like this. We've all seen a combination of danger and meltdowns in our portfolio that make us nervous. In fact, if you see the chart, and this is the only chart I wanted to show, panic levels are probably at their highest. This is evident in Google searches. This is evident in pessimism in newspapers, and panic levels are nearly at 2008 levels. But there are also tremendous opportunities. One of the things I've also learned over the last 10 years, talking to Indian investors and Indian advisors, is that it is very difficult to make macroeconomic predictions about where the economy will go. Today I was listening to something by HUL CEO Hindustan, Sanjeev Mehta, and he said he has no way to predict consumption because you don't know, one, how the economy will recover, and two, how consumers will react. So what can we do as investors? For the next 10, 12 minutes, what I want to talk about is coming back to us more personally as investors sitting in India who've gone through bleed in their fixed income and equity portfolios, and maybe a few lessons that we can take away. So I want to share 5 lessons that I've seen in observing HNI portfolios over the last 10 years, and very smart HNI portfolios at that, and then maybe end with a couple of opportunities. I will take, because this is my own club, I will take the liberty to be extremely frank in my thoughts. I think the lockdown has made me a far more frank person than I usually am. So Rohit, if you could do me one thing, if you could just flip down a couple of slides to where there are 5 points, and I'm just going to go ahead.
Is it this one? Yeah. All right.
So this is the only slide we're going to talk about. So 5 things to remember if you are sitting in India today as an HNI trying to invest, because I do believe a lot of the pain that you encounter in a bear market is actually the function of things that you do in a bull market. And as Punita said, markets go through various kinds of cycles. There are a couple of things to keep a watch for. The first point that I made is that it's very important to distinguish capital risk from all other kinds of risk. And the most common mistake that we're seeing HNIs today make in their portfolio is try to extract that extra cream of return and in the end compromise capital. I'll give you an example of this from a few years ago. Some people have gone through the painful experience of investing in NSEL, that was the National Spot Exchange, where for a certain period of time you were earning, fixed income rates were about 8-9% at that point, but you were probably earning 12 to 14% returns on your portfolio in some kind of commodity arbitrage. At the end, a few years later, I think about 6,000 crores of HNI capital was trapped in that. And a few years later, obviously, the exchange wound up and it turned out to be a large scam. I see some of that happening with credit-driven investing today. In a country where credit markets have historically been very, very illiquid, and by the way, they are getting significantly more illiquid now, I would really urge investors to carefully look at the fixed income allocations in their portfolio. Today, overnight rates in India are 3-4%. The 10-year GSEC is at 6%. The simple AAA public sector bond index is about 7%, so 7.5 actually. So you're getting a 1% spread above sovereign for investing in the best rated public sector companies that are quasi-sovereign. And then there are credit funds and structures that are at 12-13% plus. My one advice to you is do not compromise capital for this kind of cream in your portfolio. I do think that the one risk you have ahead of you is significant amounts of corporate downgrades and defaults. That could pose very, very dangerous. I think investors are up for taking equity risk, but from what I have seen, fixed income risk is something that we neither understand nor are very comfortable taking. So I would be very, very careful about looking at fixed income risk in your portfolio today. Also realize that in today's market, even the most liquid paper, that is your AAA corporate bonds, are significantly less liquid than they were before. Credit markets are largely frozen. And if funds like these were to have significant redemptions, many of them are open-ended funds, then you could be in a sticky situation. The second point I wanted to make as far as Indian investors are concerned is it's very important to watch out for correlations in the market. And what does this mean in English? We invest across different asset classes. We invest in funds, we invest in equities, we invest in fixed income. And in a good time, all is good. We do not realize when there is a market unwind, a lot of asset classes actually become very correlated and they unwind together. Many of you are also owners of businesses. So business performance is also highly correlated to equity market performance. A lesson I learned in my career very personally in 2008 is that I work in a capital markets industry. And so does my husband, as some of you know. So essentially I am a 3 times levered bet on the stock market. And hence my personal portfolios are very, very conservative. Do remember that if you're doing substantial amounts of equity investing, but you're also investing in credit funds, etc., all those asset classes are correlated and they can come to an end pretty quickly and together. One thing that we do see in India is a significant sense of home bias. So typically 90 to 95% of Indian investors' portfolios are in Indian investment markets. Rohit, if you just flip to the next slide, I definitely encourage you to look at global markets as a source of investment. This is just a map of the best performing market year on year and the worst performing market from 2009 all the way till 2020. As you read it, India was the best performing market in 2009. As Punita said, China is ironically the best performing one in 2020. There are 2 points to make here. One is obviously the best performing economy in the world changes year on year. It's very difficult to predict that. And hence diversification is important. Secondly, if you look, and I don't mean to sound like an India bear, but if you look at the right, what it shows you is markets ranked by return and markets ranked by volatility. The US is actually the best performing market over the last 10 years on return. It's also the least volatile market. So India, by the way, is one of the most volatile markets and one of the worst performing. I don't again mean to sound like an India bear, but I do think that for Indian investors, there is a substantial case for diversification, particularly because your currency depreciates at about 3% a year. So if you're not looking at diversification in your portfolios already, given all global markets have corrected, I highly recommend you to. If you could go back to the previous slide. The third point I want to make is that if there are 2 things that you should run away from today, it is excess complexity in your portfolio and high costs, and usually they are linked. When we see HNI behavior in India, typically you get questions that I have a portfolio of 1 crore or I have a portfolio of 2-3 crores. Is it time to start buying, the next cool idea that hits the market? Is it time to start investing in something structured? Is it time to start buying some infrastructure growth story in a locked up fund for 5 years? You end up paying a very, very high cost to do this. Narratives are, in my view, very, very glamorous. I think it's the easiest thing to go out and sell a narrative. I would highly encourage you to run away from complexity in your portfolios. I was talking to a friend today who I believe is one of the more evolved super HNI investors. And he said that after 10 years of investing in Indian markets, his portfolio has come down to a debt ETF, a liquid fund, and 3 equity mutual funds. And that's about it. And it's a function of investing in very high cost and complex instruments, that appeal very glamorous. And I can talk about specific examples in the Q&A. But every time you're sold a story that's a 5-7 year story, a very, very niche thematic story, please be careful. In fact, if you go 2 slides down, we did an interesting analysis at Edelweiss Mutual Fund that if you look at sort of the best performing story, the story that historically sold in Indian markets over the last 10 years, and you invested in, kind of the story of the season. So in 2007, that was infra. In 2008, it was debt funds. 2010, it was gold. There was an FMCG phase, a pharma phase, a mid-cap phase, a small-cap phase. I can tell you right now is the healthcare phase. Everybody wants to invest in healthcare funds, even if they know nothing about healthcare. The blended return that you earned was about 10% on your portfolio. This is chasing and getting everything in fashion, right? If you look at the right, that's the performance of the Nifty TRI, that's 11%. So chasing stories is sexy. It often doesn't do very much for your portfolio. If you can go back, the fourth point I wanted to make, and this is one you see so much in a crisis, is resist the urge to take action in your portfolios. Many of you, without taking away any respect to the industry, work with various advisors, various asset managers, and we all love action. We like to do things. Action becomes very costly. I'll give you an example from 3 weeks ago. There's a category of mutual funds in India that is meant for 3 to 6 month parking of money. It is called arbitrage funds. It is vanilla cash futures arbitrage that you probably learned in Finance 101 at Wharton. And it was moving along very steadily. A day came along when for a few days, because of dislocations in financial markets, and dislocations happen, arbitrage returns turned negative. 3 industry players decided to put out notes saying that arbitrage funds are over, all HNIs should exit. Something similar happened in liquid funds, by the way, where returns turned negative for 3 days because of sharp movements by the RBI. 50% of investors exited the arbitrage fund industry. A bunch of investors exited liquid funds, and they all parked that money in overnight funds, which were yielding probably about 3-4%. At that point, I was trying to run out and put out communication that nothing is wrong, guys. Just because 3-4 days of asset class returns are negative, should you take action in your portfolio if you've invested for 3 to 9 months? I don't think so. Things turned around. Now the same investors are moving back from overnight funds to these asset classes. What have you achieved in the process? Well, you've probably paid some exit loads and you've probably paid some tax. So my request is to resist the urge to take action in your portfolios. You're in extraordinary financial times where there will be short-term dislocations in asset classes. It's not worth judging basic asset classes by short-term dislocations. The last point I wanted to make to you, and this is again something that we've seen in a lot of HNI portfolios over the last few weeks and months, is that liquidity is your best friend in a crisis. Resist the urge to lock up your portfolio in illiquid assets, and this is happening more and more. There are HNI portfolios today that are 90 to 95% locked up in illiquid assets, and the consequence of that is twofold. One is that you feel very uncertain because a lot of these illiquid assets are correlated and do badly together. The second is times like this call for personal liquidity and they call for business liquidity. You then have to liquidate equity assets or credit assets, which are really not liquid at this point in time, at suboptimal rates. I always say that if something is liquid in a crisis, in normal times, it becomes less liquid now. But if something is less liquid in normal times, it freezes completely. So I would recommend that, and this is very basic advice, keep a certain percentage of your portfolio completely liquid and resist the urge to do anything complicated in that part of your portfolio. It will really help you in a crisis. do work with whoever your financial advisor is and monitor the liquidity of the underlying funds that you're invested in. A lot of us actually publish liquidity metrics. It's not sexy to talk about liquidity in good times, but liquidity is your best friend in a bad time. So do ask the tough questions on liquidity. I finally want to leave you with two thoughts. As far as investing is concerned, I think markets are in a storm. I don't believe the storm is the best time to make any kind of strategic decisions because genuinely your mind is very crowded. You will get tremendous opportunities to invest in equities. You don't need to be a hero and do it immediately, but you can stagger it and do it over some course of time. You have very good opportunities today to invest in high quality fixed income. So just like the fashion slide, the basics are in place. The basic opportunities are going to be there for investors, and investors will have a very good time just going through the basics. And stick to the basics, you'll do absolutely fine, and would be happy to answer any questions after this. Thank you.
Thank you, Radhika, and thank you, Punita, for some valuable perspectives on investing. Let me start with, so Abhay and I will pick some questions. So Abhay, would you like to go first with any of the questions you've been monitoring?
Yeah, I think, so again, thanks a lot, Punita, and thank you, Radhika, for that. Very, very useful, at least for me. There are a few questions coming in. There is one from Piyush, which is interesting, which asks, would you recommend investing in a fund that tracks the volatility index since it's negatively correlated to equities? Very specific, but an interesting question. Radhika, would you want to take that? Hello?
Yeah, sorry, I was muted. I can take that. I suspect this is a global fund, not an India fund, because I doubt you have this kind of fund in India. I'd have to talk about the specifics of the fund, but in general, I mean, there has been a strategy globally also called tail investing, which is to have some part of your portfolio in assets that are completely negatively correlated to equities. I don't think it can form a very large chunk of your portfolio, but if it's a small couple of percent, depending on the fund specifics, of course, but this has been a popular approach. It's almost like buying insurance in your portfolio.
Okay, thank you. I think a lot of questions in general in terms of, and you very well answered a lot of them in terms of, keeping, maintaining liquidity and a few options in terms of investing, especially fixed income. But there are questions around what are the opportunities and the time frame in general. Yeah. And in terms of specific questions, of course, the question, one question that we kind of even sent out for the webinar itself is a lot of people are asking if we already hit the bottom. And of course, there's no way of knowing that, but we've just seen a sharp rally from the bottoms in end of March or the third week of March. So would you like to talk about that, or is it just a bull trap as they call it, or any thoughts on that? Both Punita and Radhika, I'd love to get your thoughts on it.
I mean, I can start with this. I think my thoughts on equity, and I'll also take the fixed income one since you alluded to it earlier. I think my thoughts on equity are it's almost impossible to time the bottom. As smart people, we believe that we have some kind of information edge. I've come to believe that we don't. And every bear cycle will have bits of spikes of bull rally. I think the only thing you can do is apply frameworks. And when Punita spoke, she spoke about the fact that, look, valuations are better than they were before. I mean, India has probably gone from 23, 24 to 17, but it's also been at 11. And can you have an excellent answer to that question? No, because you don't even know how long the lockdown will last in India and what its impact on business and economy will be, even though COVID is settling down in some other global markets. I'll quickly, before I hand it over to Punita, take the question on fixed income time horizons. I mean, some of the things I will recommend are, longer term fixed income investments. Obviously, short term, you can do what you want, but even 3-year fixed income investments where you get the benefit of capital gains taxation in India are very, very attractive in the sort of AAA segment. 10-year investments are really, really attractive. So if you look at 10-year AAA public sector bonds, that's about 7.7%. On an after-tax basis, that's almost close to 7%. That's pretty good from an India point of view. Spreads between AAA and GSEC are at their historical highs. State development loans are at their highest. So for quasi-sovereign credit, you're getting, if you have a little bit of a long-term time horizon, you'll do well. Even if you don't, you can buy 10-year assets and sell them in 3 years. I think that's a fantastic opportunity.
Okay, thank you.
So,
Rohit, any questions?
Yeah, so
sure.
can I just answer that as well, as Radhika said, Abhay? So very quick, my charts showed that we haven't hit the valuation bottoms, but on some parameters, we're getting there. I think the key to watch is how this health crisis resolves itself in terms of vaccines, cures, lockdowns, because the impact on the economy is going to be determined from how soon we come out of this. And if the impact on the economy is short-lived, it's a 2-3 month thing and it's business back to normal, then yes, valuations are becoming quite attractive. But of course, if this thing prolongs and it really becomes like a full economic crisis, then it's going to probably behave more like the previous economic crises we've seen.
So Punita, there's another question for you, which is, do you believe the quantum and the quick fiscal and monetary response in the developed world will limit the downside to the economy and hence the markets or the rebound? So you sort of alluded to it, but if you could just answer this specific question as well.
I think to some extent it will. Definitely. I don't know so much about Europe. From the US perspective, I think they're doing whatever it can to prevent like a far worse situation than would have emerged. But that doesn't mean we won't have a recession. I think we could probably still have a recession again, unless, as I said, the health crisis resolves itself sooner rather than later. And then it would just be an impact of 2 or 3, 1 quarter's contraction on GDP. But if it prolongs it, then it becomes 2 quarters or 3 quarters because of the shutdowns. The stimulus isn't going to completely take away that pain.
And what do you see the impact to corporate earnings? I mean, earnings will start coming out from tomorrow or sometime this coming week. Do you think the markets have already factored the outlook to some extent, or do you think that we may actually start seeing the real bad news coming out now?
I think that, of course, I'm on many boards, so we are going to be releasing earnings and over the next 3 weeks, 4 weeks. So the earnings, well, first of all, it's the next year's earnings, fiscal, starting April 1st to March. That is going to be more impacted than what is going to get reported, because what is going to get reported is only going to have 1 month of lockdown and impact, right? So don't go by what is reported. You have to look at and I think, frankly, nobody really knows how the earnings are going to be over the next 12 months, because it's a question not just, even if the lockdowns are removed, the question is, do you get your labor back to have manufacturing capacity again being fully utilized? So it's becoming industry specific, and also companies with high debt are going to be more impacted than others. So I think it's going to get more selective, and there are a number of factors, including your workforce and how you're going to retool them and how you're going to think about your work going forward. But I think earnings impact can be quite severe over the next 12 months if we are not able to kickstart everything back.
Right. So thank you, Punita. Radhika, I'm just going to combine 2 questions for you, which have come in. So one is sort of one-line statement for non-HNI individuals who form a bulk of Indian investors, as well as, which are the funds to stay away from? You mentioned the illiquid funds specifically. So is are liquid funds safe right now? and how should where should one park money for capital preservation?
Sure. So the first question on advice for non-HNI investors, I actually believe that, whether you're retail or HNI, the basic principles of investing should not change. I think you get into a mode when you're an HNI because you're smart, you should do a lot more things. But I think the answer doesn't change. I think for retail investors too, the answer remains the same. I think we are a heavily under-penetrated country in terms of investing. I mean, our market, our MF penetration to GDP is some 4-5%. The world average is 40%. So we have miles to go before we sleep. Let me take the question on kind of funds. I think in equities broadly, if you're looking at the whole spectrum of equity mutual funds, you're okay. There's nothing problematic. I would avoid PMSs that are very, very illiquid, concentrated in the small cap space, because they'll struggle with things like liquidity. But I think broadly, if you look at in the equity space, most funds are okay. If you're looking at investing in mid and small cap funds, my caution would be to avoid very large funds. When you're 10,000 crores and running a small cap fund in India, it's unadvisable because you will eventually struggle with liquidity and you can't be nimble. In fixed income, I'll break it into two parts. For under 3 years, for under 1 month, you can look at overnight and liquid funds, very, very simple. For anything above 1 month to 3 years, you can look at short-term funds, you can look at arbitrage funds, which I mentioned, very, very strong post-tax returns without credit risk. Above 3 years, I would look at any good corporate bond fund or AAA fund. I would avoid credit risk funds entirely today. That's the big avoid. Or any fund or fund house that takes significant less than AAA exposure. I think that's the important thing. Obviously, I'm a big proponent of bond ETFs, but this is not a personal plug. So low-cost bond ETFs are also a very attractive option right now.
Okay, great. Punita, there are 3 different questions related to the meeting you had with doctors, the webinar you mentioned with the physicians and what their outlook was. So is there anything in terms of how long they think it'll take to find a cure, and how long do you think that may therefore impact the way the business world is working and therefore earnings, if you go just with what the doctors are saying?
Yeah, so I was, my conversation was all the people mostly in Boston area. So their views were, well, from a lockdown perspective and things becoming normal, they think that the vaccine is they think it's going to take a year, because and the trials, if done properly, can also take about a year to come up with a proper cure. But of course, they can be experimental drugs, and in some cases, the FDA is accelerating, their traditional approval systems. So things there may be some medical cure that may be announced in the next maybe 3 months. Pfizer, as we've seen, has already said that they're working on a few cures, and vaccines are also in development by a few people. So within a year, they felt that there could be some cure, but they also felt that nobody should travel till June, and there should actually be lockdowns till June. That was their view, that May is too soon for opening up things, because this virus is quite deadly, and it is quite contagious, and nobody really still knows how it spreads.
Got it. So this is a question for both Punita and Radhika. There's a question on, and again, there are a lot of questions in terms of just asking about the timelines, predictions on the levels, and so on and so forth. So don't want to put you in a precarious position there in terms of making predictions. I know these are all uncertain times. This is one question, just talking about Nifty, and it's talking about will Nifty go down to 7,500 mark again? Again, very specific question, you can avoid it. But it's talking about in a month or 2 months. Again, they're asking about timelines. Given the recent short rally, is it not sustainable? Will the earnings be stressed? So a lot of questions around the same theme in terms of asking about the timeline, asking about how much of a fall can we expect in the coming months. So just be great to just get your personal thoughts on this, and of course, with the caveat that we can only predict and know as much as anyone else right now. Like things are things are in flux right now. But it would be great to get your thoughts on this, the timeline and the bottom, and how far further you expect it to fall.
Radhika, you want to go first?
Yeah, I mean, I'm going to give a very short answer. I am unfortunately not an astrologer. And I genuinely think you can't predict these things. The 2001 correction took a month to come back. The 2008 correction took 27 months to come back. How quickly things come back. There are three kinds of recoveries in basic economics. There's a V-shaped recovery, there's a U-shaped recovery, there's an L-shaped recovery. You could have a V-shaped recovery where there's a temporary output disruption and then things come back. But you could also have a long, and we don't like to think about it, a long, prolonged L-shaped recovery where there's genuine demand destruction. I think it's difficult to predict. So I'm not even going to venture to predict 7,000 or 8,000. Every time someone asks me this on TV, my answer is I'm not an astrologer.
Good one. Okay, sure.
Yeah, and I think I agree with that. It's hard to predict. Investing is an art, not a science. And in this time around, of course, we have a science, which is a medical science, an important contributor to what might happen. So I think you have to watch the data and the news. I think markets are going to be volatile. They'll react to news. So I just saw somebody ask or put there saying, oh, will BC India will announce a fiscal stimulus. Well, if there's a good news, markets will react positively. If there's bad news, they won't. I think it'll remain jittery until everything is fully resolved. It just depends on how soon, as I said, ultimately we find a way to deal with this health issue, cure or vaccine, or it just goes away in the summer, seasonality. I don't know.
Okay, thank you. Quick follow-up question on this. On the stimulus itself, like Punita, especially for you, how much do you think can stimulus really impact the markets? Of course, we are seeing the US, given the election year, the president's trying, and the president with the Fed trying their best to kind of pump up the markets or help in the recovery. But given the everyone's in a lockdown, the consumer demand is crashing. How much do you think can the stimulus really make an impact? And especially given like the disparity between what the US has given, which is like 10.7% versus India, which is 0.8%. So now, like,
well, I think the stimulus is really more like a life support right now. It's really just easing the pain for those who are getting laid off, and the businesses, small businesses. I'm just talking about the US right now, and so that people who are losing their jobs, and companies that need the cash and liquidity from banks are able to be liquid and survive the next few months. So it's really to prevent a sharp decline in demand and economic output in the next or sort of the pain of the economic decline. So I don't think it's really going to. If companies can weather this during this time and they're viable, then they can rehire workers later, right? So I think that's the intention.
Okay, thank you.
So so question for both of you, and we'll start Punita with you first, and then with Radhika. How would you recommend people do the portfolio allocation between India and global, and within fixed income and equities, given where we are right now?
So maybe actually Radhika should go first, because she's more being focused on the personal finance, and then I'll add to it.
Sure. So I think, and this isn't a great answer, but I'll try to enunciate it a little bit. Obviously, I think portfolio allocation is a very personal decision that is a function of your business and other circumstances. Broadly, I think for Indian investors, international assets should form at least 10% of your portfolio. It could go up to as much as 20-25%. But if you're not doing international assets, I would definitely get your feet wet with 10-20%. Definitely look at markets like the US, definitely look at markets like China. Do look at interesting themes, that are available internationally. For instance, one thing that we do know is that technology is a theme, and a lot of sort of big technology companies, whether in cloud or 5G, etc. I mean, for India, in our Indian indices, in the Nifty, IT is essentially outsourcing. You don't get any of that. So look at some of those themes that are available via international assets that are completely uncorrelated to India. As far as your fixed income and equity allocation, I think today, if you were starting from fresh, it would be more biased towards equity just because the opportunity is bigger than equity. But it's a very personal decision. So whether you are 60-40 or 70-30, the bias definitely should be towards equity. I mean, 60-40 is the natural kind of split, but it's really a function of personal circumstances. And I think one thing that if you're a younger investor, one thing that this kind of down should teach you is what your risk-taking tolerance is. I mean, that you should have got a good hang of in March. I mean, you really have to be with what you're comfortable with.
So I will just add a slightly different perspective. Of course, depends on where you are located. If you're located in India, then what Radhika is saying is correct. And if you have the ability to have more dollar-denominated assets and diversify away from just being India-centric, then obviously that's an important consideration. I think given the volatility, whatever you do in terms of allocation, you should dollar cost average or rupee cost average, however you may want to look at it, so that you are not going all in or all out, because there will be volatility, and you can sort of smoothen your gains and losses by actually averaging in over the next few months. And yes, I think you should be diversified. Sorry, Radhika already mentioned that. But the extent of your diversification depends on where you're located and what's your flexibility.
So thank you for this. I think there's probably one other question related to NBFCs that, given that they were not in the best of health, what's the current take? And, again, how would one even exit those if they're highly illiquid?
I can take that. I obviously come from NBFC parentage. So firstly, NBFC stock is liquid. NBFC bonds may be less liquid, but I think credit markets are illiquid. So it's not just NBFCs. I think, look, to give credit to NBFCs, NBFCs have been going through a challenging time since September 2018. It's been 2 years of this, and NBFCs have survived. I think if you would tell banks that, run with 20% of your deposit base going in a single day, most banks would struggle to survive. I think within the NBFC pack, there will be good NBFCs and there will be bad NBFCs. Obviously, real estate and wholesale books are going under some stress. I think when you look at an NBFC, there are a couple of things to keep in mind. NBFCs don't fail because of NPAs usually. NPAs dilute your earnings, but NBFCs don't fail on NPAs. The second element is leverage. Watch out for the leverage in the particular NBFC. I mean, I know a number of players are taking leverage down, but leverage is usually, this is what we learned in the 8 days also. Leverage is usually what hurts an NBFC. And the third thing that people often don't pay attention to is if you look at most of the credit failures that have happened in India over the last 2 years, they are also very bad corporate governance. They are inter-promoter transactions and a lot of things like that happening. So earnings quality and NPAs is less of your stress. Leverage and corporate governance more. I think there is no one blanket answer for NBFCs. RBI is also doing quite a bit. They announced LTRO so that banks can go ahead and buy some of this paper. I don't know how much will actually happen. But NBFCs are critical to the financial system because there's a segment of the economy, MSMEs, to which no one is lending. So you have to have a thriving NBFC sector for India's financial sector to continue.
And I will just add, I'm on boards of several, I mean, I have been on boards of NBFCs, and it's also very sector dependent. It depends on where your NBFC's underlying um, base is in terms of their assets and liabilities. So it's very sector specific. If you're an NBFC that's lending to, let's say, auto components or infrastructure, your experience will be different in both cases. So I think you have to also look at the underlying pool of their sectors that they're lending to.
Yep.
Great. So I think we have a couple of questions on real estate, which is that sector has been struggling. You've mentioned it in your, uh, in some answers earlier. Where should an investor invest to get a reasonable return in the next 1 to 1.5 years? So obviously,
Punita, I'll give that to you.
What? Sorry?
Punita, I'll give you the real estate question. I can't confess to be a real estate expert.
Well, I'm not a real estate expert either, although I'm on the board of the Embassy REIT, and I was on the board of Shobha, and so I have a little bit of experience, both having been on the board of a developer as well as on a REIT. And I think it again goes back to, if you're not highly leveraged, and if you, are you talking more from a company perspective, or what's going to happen to the real estate market? Now I've lost the question.
I think so what would happen to real estate and where are the risks or opportunities? And then within that, I mean, not relate. And the next part of the question is where can one really find opportunities where you can get a good return in the next year or two?
Well, so just like equity markets, I think even real estate markets have their own cycle. And given if interest rates keep getting cut, at some point real estate, between the distress and the prices that you can buy your assets at, and the mortgage being so much a lower cost, obviously I think it would become an attractive sector to have in your portfolio. In terms of where to invest, I think when you invest in companies, make sure that those companies are in completed projects, so their cash flows are more and more are in close to completion, and they haven't leveraged themselves. So because otherwise you're going to have working capital and other issues. So that's so. For instance, I mean, I really don't want to talk about the companies I'm on the board of, but generally, if you are in commercial real estate, in the past, that last couple of years, that was a sector that was doing better than the residential, because if your underlying tenants are, in case of some of our tenants, it was all foreign, generally foreign companies who had outsourced to India, and so the likes of Google's, etc. So those businesses were doing quite well, and rents were were pretty healthy. Some of I think while commercial was doing better than residential, I think residential, the prices, as I said, might pick up as well. And on the commercial, there could be some, depending on who your tenants are, and what is happening to their businesses. We are seeing, like malls, like cinema hall, what PVRs, etc., and a lot of retailers saying that they're going to stop paying rents. So some of the commercial properties might face some challenge there, depending on, who your tenants are. So I think you have to become very careful in terms of what's your underlying book like.
I think Punita makes a good point that's applicable to general investing. I mean, whether you're investing in equities or whether you're investing in NBFCs or real estate, I mean, you have to work with promoters who have respect for capital. And I think those principles don't change, whether you're doing real estate or whether you're doing equity, any other sector for that matter. I think the strong will get stronger after a crisis like this, and then the weak don't get funding, they don't get sales, etc., etc. So I think the basic principles don't change.
Okay, so I guess we'll wind up at this point in time. Though there is one other question just came in, sorry. So I will actually, it's a little bit of crystal balling. So given the change on working cultures of work from home, what do you think will happen to the commercial real estate sector over the next couple of years? And is there a problem or an opportunity still over there?
I mean, I'll give you my 2 cents on this. I think it's early days to say, but I think a lot of companies will significantly look at the benefit of work from home. I am thinking about them, and I run a 250-person company, and we are seriously looking at migrating 50% of our workforce to work from home. These are initial thoughts, obviously, but I'm sure there are many, many managements like us thinking about this, in which case there will be an impact on commercial real estate. I think work from home is something that we've always debated, but COVID has shown us that it can actually happen. And so while it's early to crystal ball gaze, I won't rule it out completely. I mean, you'll have to see over the next few months, but a lot of boardrooms are having this discussion for sure.
So I will say that in my boardrooms, we haven't yet had that discussion. And I think while people like the convenience of not having to travel to go to the office, they also like the personal interaction that comes with it. And particularly in India, where most people live in with extended family and you don't have quite the space to work properly. And I think companies also have to really make sure that their cyber systems and confidentiality and privacy and all of that is handled. I don't think companies are still equipped to have. So I think for us, that is an important thing we have to make sure as board members that we don't just allow working from home without ensuring that the companies won't have lawsuits later on, depending on the business you're in, because there's a lot of data privacy violations that come along.
Okay, great. So I think we're out of time as well. We're getting lots of thank yous to both Punita and Radhika from several people who have been here. And, this has been at full capacity pretty much for the last hour plus. So over 100 people were including the panelists. And I think this has been a very, very informative session overall. Thank you so much, Punita and Radhika. Abhay.
Thank you, Rohit, for putting this together.
Yeah, absolutely. Thanks a lot, Punita. Thanks a lot, Radhika. I learned a lot. Thanks a lot.
Thanks, Abhay. Thanks, Abhay.
Yeah.
And thanks to all the attendees.
Yes, thank you, guys.